Imagine for a second you own a mansion, a sprawling estate.
Okay.
You've got the land, the new roof is going on, you're installing these, marble floors in the foyer. On paper, your net worth is just skyrocketing. You look like a tycoon.
Right. The asset column looks fantastic.
But then you look at your wallet,
Mm-hmm.
and there's nothing but lint and maybe a few coins. You're asset rich, but cash poor.
That is a very uncomfortable and, frankly, a very dangerous position to be in.
That is exactly the picture painted by the 2025 annual report of Erdemir Eregli, Demirvichelik Fabrikalari. We're looking at an industrial titan with total assets ballooning to over 558 billion Turkish lira.
Mm-hmm.
To put that in perspective for you, using the average exchange rate, we are talking about roughly 14 billion US dollars in assets, a massive number.
It is. It's a fortress of a balance sheet.
But then you look at the cash they actually kept, the net profit,
Yeah.
and it nosedived. I mean, we're talking a drop from over 14 billion TL in 2024 to just 694 million TL in 2025.
Wow.
In dollar terms, that's plummeting from about $350 million down to, roughly $17 million?
It's a shock to the system. You're looking at a net profit margin of about 0.3%. For a company this size, generating billions in revenue, keeping only 0.3% it's razor thin. It's basically break even.
So that's the mission for today's deep dive. We need to figure out, is this giant stumbling? Is this a huge red flag for the retail investor? Or is this just the messy, expensive cost of a necessary transformation?
And we've combed through the board of directors' annual report, the auditor's report from EY, and all the sustainability disclosures to find that answer. It's not just a factory report. It's a story about navigating a transition economy.
Right. Before we get into the scary math, let's first get to know the company a little. Because, I mean, for a lot of people, Erdemir is just that big factory in Ereğli. But that's a massive oversimplification, isn't it?
Oh, completely. Calling it a factory is like calling Amazon a bookstore. This is the OAK Mining Metallurgy Group. It's headquartered in Istanbul, but it's a vertically integrated conglomerate.
Vertically integrated meaning?
They don't just make steel, they control the recipe from the dirt all the way to the finished beam.
I was looking at the employee numbers, 12,824 people as of the end of 2025. And interestingly, that number actually went up from the previous year.
Right, and that's a key indicator. If a company is failing or trying to slash costs desperately, you usually see layoffs. Here, you see hiring. And the breakdown is telling most are hourly, blue-collar workers. This is heavy industry.
And they aren't just in one place. You've got the namesake, Erdemir, in the north, but then you have this massive sibling in the south, İskenderun.
İskenderun Iron and Steel, that's their other huge integrated plant. But the integration goes deeper. They own Erdemir Madencilik for mining, so they dig up their own iron ore.
Okay, so they control the raw materials.
And they own Kumaş Magnezit.
I saw that name. They handle magnesite and refractories. Now, for the non-engineers listening, what exactly are refractories?
Think of them as the heat shield. When you are melting iron at thousands of degrees, you can't just put it in a metal pot. It would melt the pot. You have to line your furnaces with special heat-resistant bricks. That's what refractories are.
So by owning Kumaş, Erdemir ensures they never run out of the lining for their own ovens.
It's brilliant. It's like owning the tire factory if you're a trucking company. They even have an international footprint with Erdemir Romania and a trading arm in Singapore. It's a beast.
Okay, so it's a global beast. But who holds the leash? The shareholder structure has this detail that I found, frankly, baffling. I mean, OYAK, the Armed Forces Pension Fund, owns the biggest chunk, about 50%. The rest is on the stock market.
Public float.
But then there's this single share, one share, the A group share. It's worth a fraction of a penny, but the report says it has usufruct rights.
Ah, the golden share.
It sounds like something out of a fantasy novel. What does a usufruct right actually mean for a guy buying stock on an app?
In this context, it's held by the Privatization Administration. It gives the state a veto power.
A veto on what?
On major strategic decisions. If Erdemir wanted to shut down a major factory or merge with a foreign entity, things that are critical to Turkey's industrial capacity, this one share allows the government to just say no.
So if I'm an investor, is that good or bad?
It's a double-edged sword. On one hand, it limits the company, but on the other, it implies a safety net. The government views this company as too strategic to fail. It keeps Erdemir aligned with national stability.
Okay, that's the structure. Now let's look at performance. In 2025, it seems to have been a very weird year. I'm looking at the sector data, and crude steel production in Turkey was actually up 18.5% in December. The ties was rising.
The sector was definitely recovering, yes.
But Erdemir's boat didn't seem to rise with it. or at least half the boat didn't. I'm calling this the tale of two plants. Erdemir, down south, saw production go up almost 4%, but Eregli, production plummeted by over 20%.
That is a massive contraction. You're talking about dropping from over 3 million tons to 2.6 million. For a flagship facility, losing a fifth of your output is usually a catastrophe.
Usually. But you're implying it wasn't an accident.
No, it was calculated. This is where you have to read the management commentary. They didn't lose customers, they turned off the machine, specifically the second blast furnace.
Okay, blast furnace, let's just break that down. We aren't talking about a microwave.
No, not at all. A blast furnace is a cathedral of fire. It's a massive tower where you turn iron ore and coke into liquid iron. It runs 247 for years. But eventually you have to shut it down and rebuild the insides. That's what happened at Ereğli.
So you can't make steel if the oven is under construction.
Exactly. It creates a bottleneck. And that really explains that financial nosedive we talked about earlier. High fixed costs plus lower production. That equals terrible margins.
That segues perfectly into the strategy section. Because looking at this report, the theme isn't saving money. The theme is spending money. I saw a recorded investment accrual of $775 million US.
That is the headline number. $775 million.
That seems incredibly aggressive for a year where your profits are vanishing. I mean, if my income drops, I usually stop renovating the kitchen. Why are they doubling down?
Because in heavy industry, you have to be counter-cyclical. If you wait until the market is booming to fix your furnace, you miss out on the boom. You fix the roof when it's not raining.
So where's this $775 million going, besides the blast furnace?
It's everywhere. They completed the fourth coke battery at Ereğli.
Coke battery?
It's a series of ovens that bake coal to create coke, which is the fuel for the blast furnace. Renewing it makes it more efficient and, importantly, cleaner. They're also renewing cranes in the steel shop and at the ports.
It sounds like they are basically rebuilding the entire infrastructure of the company from the inside out.
They are. And notice the green steel projects. The report puts a huge emphasis on the net zero roadmap. They're building a solar power plant at Erdemir. They're installing a top gas recovery turbine.
Is that just greenwashing? You know, putting up a few solar panels to look good for the report?
I don't think so. Not with the money they are spending. You have to remember, Erdemir exports to Europe, and Europe has the Carbon Border Adjustment Mechanism, CBAM. Basically, if your steel is made with a lot of carbon emissions, you pay a massive tax to sell it there.
So going green isn't just about saving the polar bears. It's about keeping their biggest export market open.
Precisely. It's an existential investment. If they don't lower their carbon footprint, their steel becomes too expensive to sell in the EU.
Okay, so the strategy makes sense. Modernize now so we don't die later.
Yeah.
But strategy costs money. And that brings us back to the painful part, the financials. We mentioned the 0.3% margin, but let's dig into the why. Revenue was about $5.2 billion USD. It's actually up slightly from the year before.
Right, so the top line is fine. They sold the metal.
But the cost of sales,
Yeah,
it just ate everything.
it did. You had inflation, which was still high in Turkey. Energy costs were up. But the real kicker was the efficiency loss at Ereğli. When you run a factory at 80% capacity, your cost per ton skyrockets because you still have to pay all the fixed costs.
It's like driving a car in first gear. You're burning way more gas to go the same distance.
That's a perfect analogy. They were driving in first gear for most of 2025 at that plant.
Now, there is a number here that management probably wants us to highlight in neon lights, the total assets, 558.5 billion TL. Again, that's about 14 billion USD, up from 425 billion TL the year before.
That is the silver lining. The company got significantly richer in terms of what it owns. The new equipment, the upgraded plants, it all adds to the asset base.
So if you're an investor, you're holding a share of a company that owns more valuable stuff, even if it didn't generate cash this year.
Correct. You're holding a share of a more modern asset base. But you can't pay your rent with asset base. You need cash.
Which brings us to the dividend. I honestly expected zero dividend. A 95% profit drop usually means the dividend gets completely cut.
You would think. But Erdemir paid out. 0.25 TL per share gross?
That's what, less than a single US cent.
It is tiny, but it's a signal. They're telling the market we are still a dividend payer, we are loyal, stick with us through the construction.
It's a token of good faith. Here's a penny, thanks for waiting.
Essentially, yes.
Let's talk about the things that could go wrong here, the risk factors. Because spending $775 million when you're barely breaking even is, well, it's risky.
Financial risk is the big one. They are burning cash. The report mentions high liquidity needs if interest rates spike or the steel market dips again, that debt becomes very heavy very fast.
And what about the renovation itself? I've done home renovations. They never finish on time.
That is the operational risk. The report explicitly mentions the risk of delays in the blast furnace renovations. If that furnace doesn't come back online smoothly, that production drop extends into 2026, and then you're in real trouble.
Any regulatory risks?
We touched on CBAM in Europe, but domestically there is the ETS, the emissions trading system. Turkey is implementing its own carbon pricing. If Erdemir isn't ready, that is a whole new expense that cuts into that already thin margin.
Now, let's look at corporate governance. I noticed the board structure includes independent members, which is good. But I want to talk about the footnotes. I always like to look at who is getting paid what. Note 20, benefits to key management. Do you see that number?
I did. It jumps significantly.
In 2024, the top brass cost 147 million TL. In 2025, it went up to 236.5 million TL. That's nearly 6 million USD for the executive team.
It's about a 60% increase in local currency.
Hold on. Profits drop 95%. Production at the main plant drops 20%. And management gets a 60% bump in pay and benefits. How do they justify that?
It's a bad look optically, no doubt. Shareholders might find that very hard to swallow. The counter-argument, I suppose, would be inflation adjustments and perhaps retention.
Retention.
You're asking these executives to manage the most complex, difficult transformation in the company's history. You have to pay them to stay. You don't want your captain jumping ship in the middle of a storm.
I guess. But if I'm a shareholder getting a dividend worth less than a penny, seeing the executives get a 90 million lira raise, it stings. It feels a little disconnected.
It's certainly something to keep an eye on. It raises questions about alignment between management incentives and shareholder returns during these lean years.
On a lighter note, they didn't cut everything. I like the social responsibility note. They donated an induction furnace to a local high school.
The Eregli Vocational and Technical Anatolian High School. Yes. This is actually brilliant. Instead of just writing a check, they gave them industrial equipment.
So the kids learn on the actual machines they'll use if they get hired.
Exactly. It bridges the skills gap, it solves a future hiring problem for Erdemir, and helps the community. It shows they're thinking in decades, not quarters.
Total donations were about $1.7 million. It's nice to see they didn't cut that to zero.
It's a good sign.
So let's wrap this all up. We've dissected the giant. We see the crumbling profit, the massive assets, the expensive renovations, and the strategic bet on green steel. What is the verdict here?
The verdict depends entirely on your time horizon. If you are looking for a quick flip, a quick profit, this report is ugly. The margins are non-existent, and the cash flow is very tight.
It's a stay away for the day trader.
Absolutely. But if you are a long-term investor, look at what they are building. They are using this downtime to create a hyper-efficient green steel monopoly. They have the mines, the ports, the factories, and soon the modern tech to beat the carbon taxes.
So it's like we are standing in front of a skyscraper that is covered in scaffolding. It's dusty, it's noisy, and you can't live in it right now. But the blueprints, they look incredible.
That is the perfect analogy. The asset base, that $14 billion of infrastructure is the foundation. The $775 million investment is the scaffolding. The question for you, the listener, is, do you have the patience to wait for the cement to dry?
And that is the question we leave you with. Are you buying the dust or are you buying the blueprint?
And just remember, we are analyzing the documents. We are not giving financial advice.
No.
Always do your own due diligence.
If you enjoyed this deep dive into the guts of the steel industry, smash that like button, subscribe, and check out our membership for more breakdowns of the industrial giants that run the world. Thanks for listening.
Until next time.